A bright green screen flashes late at night as stock prices surge toward historic highs. The investor feels a rush of excitement watching a single high-flying stock grow until it dominates their entire account balance. It feels like absolute success, but beneath the surface, a quiet financial danger is building. The initial plan was carefully balanced, but unchecked growth has secretly transformed a disciplined investment strategy into an unintended gamble. This silent shift away from your original financial plan is known as portfolio drift. It happens naturally when certain winning investments grow much faster than the rest of your holdings over time. When stock prices climb during a prolonged bull run, your original target asset allocation breaks apart. A balanced portfolio that started as 60% equities and 40% bonds quietly turns into 80% equities without buying a single extra share. The central paradox of long-term investing is that your greatest market gains leave you completely exposed to your worst financial losses. When you ignore portfolio drift, your portfolio becomes heavily weighted toward whichever sector just experienced a massive run. To fix this growing vulnerability, you must perform an action that feels totally counterintuitive to human psychology. You must systematically trim your winning assets and reallocate those funds into underperforming areas. Every traded market asset operates under the mathematical law of mean reversion, which dictates that extreme prices eventually pull back toward their historical averages. When an asset skyrockets far above its underlying value, its future potential return shrinks while its short-term risk explodes. Holding on to an overvalued asset simply because it performed well yesterday is one of the most common ways investors destroy capital during market turns. Consider the classic example from late 1999 during the peak of the dot-com boom. Technology stocks were soaring daily, and investors who left their accounts on autopilot watched tech holdings expand to consume nearly their entire net worth. When the speculative bubble finally burst in 2000, investors who failed to execute proper portfolio rebalancing saw their lifetime savings collapse by over 80% in a matter of months. In stark contrast, investors who maintained a disciplined rebalancing schedule throughout 1999 systematically sold small portions of their tech holdings as prices rose. They continuously harvested profits at market tops and moved that capital into stable, high-quality fixed income assets. When the technology sector crashed, their overall wealth remained protected because their systematic risk management mechanism had systematically removed risk before the collapse occurred. The human brain is naturally wired to chase recent momentum and fear short-term losses, which creates a massive psychological barrier to sound management. Selling a stock that is climbing rapidly feels like cutting short your success, while buying an asset that is falling feels like throwing good money away. However, systematic rebalancing removes emotion from the investment process, replacing impulsive gut feelings with mechanical mathematical execution. Without a strict rule-based strategy, retail investors consistently buy at market tops during moments of extreme optimism and panic sell at market bottoms during periods of terror. Systematic portfolio rebalancing forces you to execute the classic discipline of buying low and selling high. It turns market volatility from a destructive threat into an automated engine that actively drives long-term returns across every market cycle. The real mathematical advantage of portfolio rebalancing becomes clear during extended periods of market turbulence. Mathematically, if an asset drops by 50%, it requires a full 100% gain just to break even, a structural drag known as volatility decay. By trimming overperforming assets and purchasing depressed ones during price swings, rebalancing dampens portfolio drawdowns and accelerates the mathematical speed of recovery. A powerful illustration occurred during the 2008 financial crisis when global equity markets suffered severe drops. Stock prices dropped by nearly half, while safe government bonds appreciated as capital fled toward security. An unmanaged portfolio was left heavily skewed, leaving the owner with reduced stock exposure precisely when equities were trading at generational discounts, preventing them from capturing the eventual market recovery. An investor who strictly rebalanced in late 2008 faced a difficult emotional test that required unwavering strategic discipline. They were forced to sell their top-performing safe bond holdings and transfer that capital into severely beaten-down equity index funds. When global markets staged a powerful rally starting in 2009, those newly acquired low-cost shares multiplied rapidly, driving total portfolio returns to historic new heights. To implement asset allocation effectively, investors rely on predetermined execution models such as calendar-based schedules or specific percentage threshold bands. Under a threshold model, rebalancing occurs whenever an asset class deviates by 5% or more from its target weighting. This mechanical approach keeps risk management continuous and objective, eliminating the temptation to forecast economic cycles or guess market movements. However, implementing a rebalancing strategy without considering real-world friction can introduce unwanted tax drag and transaction costs. Selling appreciated assets within taxable accounts triggers capital gains taxes, while frequent trading reduces capital through commissions and bid-ask spreads. Experienced investors minimize these costs by executing trades within tax-deferred accounts or by directing new contribution cash flows directly into underweighted asset classes. Integrating dollar-cost averaging with continuous rebalancing creates an efficient method for deploying new capital over time. By allocating regular cash contributions directly toward whichever asset class is currently falling short of its target allocation, you correct portfolio drift without triggering taxable sales or incurring unnecessary transaction costs. This silent execution method protects compounding wealth while keeping overall structural expenses remarkably low. From a modern portfolio theory perspective, rebalancing controls an investor's overall beta, which measures portfolio sensitivity to market swings. Capping exposure to high-risk assets prevents unexpected drawdowns that could panic an investor into abandoning their plan during market downturns. Maintaining a stable risk profile ensures that long-term portfolio volatility stays aligned with your actual capacity for taking risk. Managing your asset allocation is not about trying to pick winning individual stocks or outsmarting institutional traders. It is a systematic process of harvesting gains from fully valued assets and replanting that capital in undervalued opportunities. Over extended time horizons, this structured harvesting process builds durable compounding momentum while shielding your core net worth from permanent financial impairment. Looking across multi-decade market cycles demonstrates that unmanaged portfolios inevitably suffer catastrophic drawdowns during secular bear markets. Investors who ignore portfolio drift often see decades of accumulated wealth erased when extended market trends suddenly reverse course. Conversely, investment portfolios governed by strict rebalancing mechanics consistently survive severe market dislocations with their foundational capital intact and ready to grow. This rigorous operational discipline is what separates casual market speculators from long-term generational wealth builders. While financial media lures investors into chasing short-term momentum, true wealth preservation relies on compounding risk-adjusted returns over decades. Protecting capital through systematic risk management ensures that your financial foundation remains resilient regardless of broader economic volatility or sudden market panics. Mastering long-term investing requires recognizing that human emotion will almost always urge you to take the wrong action at the wrong time. When market euphoria encourages you to buy more of an overhyped asset and widespread panic urges you to sell at rock-bottom prices, a rebalancing strategy enforces discipline. It stands as an unyielding rule that guards your wealth against human error. Ultimately, portfolio rebalancing is the essential risk management mechanism that drives long-term returns across decades of investing. By converting market volatility into systematic buying opportunities, it maintains your target asset allocation and protects capital against destructive drawdowns. Adopting cold mechanical discipline over emotional speculation remains the single most reliable path toward achieving true financial independence and lasting wealth.